Luke Smith, financial planner at Envision Financial. How are you?
Mate, I'm really good,
2019.
Yes, look, lucky to be here after a sneaky mountain bike accident. So,
what happened to you? Fall off? Oh! Ouch.
There's one for the viewers.
Ouch. 200 stitches in his left hip.
Just about.
What did you do?
Oh, I just confused ambition for ability.
Mate, you're a financial planner. You've got to plan things better than that. You don't want to fall off your financial bike.
All I could think while I was flying through the air was this will definitely be an income protection claim.
And did you?
Oh, don't know. See what I've broken.
Well, income protection, you talk about that a lot to make sure that your finances.
Yeah, well, that's it.
Sure.
And because I took it up after I took my policy out, I'll be fully covered. So
there you go. You see, it'll come back to please you.
Just in case.
We're going to talk about catch-up concessional contribution legislation. You've done the head-in for the first time in 2019. What is a concessional contribution legislation?
All right, so what the government have done is they've changed some piece of legislation. So if we take a step back, on one of the shows last year, we talked about making a deductible contribution.
Right.
And the maximum amount of money you can put in any 1 year is $25,000.
Right.
Now, what the government have done is they've said, for people that haven't put in that $25,000 in a particular financial year, from the end of this financial year, so from 1 July 19, you'll be able to catch up what you haven't put in an individual financial year up to $25,000.
That's you physically doing it.
Correct. So I'll give you an example. Let's say my employer puts $10,000 into super. I have a $25,000 limit. So I've got $15,000 of cap that I haven't used. If in the next financial year, okay, when the legislation starts, in the next financial year, if I haven't used that $15,000, in the 19-20 financial year, I could put $25,000 in, plus the 15 I haven't used this year.
There you go, 40 grand.
Yeah, so really, really good piece of legislation that will be very, very powerful in a number of different ways that we'll touch on in a moment.
Okay, so you do this physically yourself, don't you?
That's right. So
your employer doesn't do this.
Well, the employer can put in part of that. So under most people's employment arrangements, you'll get superannuation guarantee contribution, 9.5%, and that counts towards your $25,000 limit.
Why was it created like this? What's got? They have a sudden rush of festive blood to their head or something?
I think it's another illustration of looking at legislation that's been passed and realising that they need to give something back. And this is a really good piece of legislation that, used correctly in the future, will be very, very powerful for people. Now, there's some certain rules that we need to sort of make sure we play, between the goalposts. But they've brought this in to try and incentivise people to continue building super. They've brought this in to be able to give people the ability to catch up if you haven't used your maximum cap. Now, we know that the average mortgage in Australia is a lot higher than it was 10 and 15 years ago. So the primary use of people's discretionary savings is paying off a house. So for some people in certain income brackets, it's harder to max out your $25,000. So in years where you haven't used it, from the 30th of June this year, you'll be able to use some of your savings or existing assets to try and add additional funds to super within that 5-year window.
Okay, so most of us get 9% super from the employer.
Yeah.
Okay, so this is a top-up?
Yeah, well, it's a way of being able to increase what you haven't used. So in any one financial year...
When you say haven't used, what do you mean haven't used?
Okay, so in any one financial year, the maximum amount of money that you or I could put into super and claim a tax deduction is $25,000. And in the example I gave you earlier, if my employer put in, let's say 10, I could then put $15,000 of my own money in.
Yep.
That gets me to my maximum limit. However, if I couldn't afford to do that, or I'd had a child, or my wife's at home with little ones, fell off my bike, was on an income protection claim, or any other reason, just general living, where you haven't been able to put in that maximum 25, whatever you don't use will carry forward for a 5-year period.
I was going to ask you, how long does this last now?
Yeah, so it starts. You can use it from the end of this financial year. So from 1 July 19 onwards, whatever you haven't used in this financial year, you'll be able to carry forwards for a period of 5 years.
And at the end of 5 years?
Then you'd reset your start and go again.
Oh, okay.
That's right.
And you can do this from the get-go of your first day of employment?
You can do this from any time from the 1st of July this year. So let's say over the course of the next 6 months, you've put 10 in, to stay with the same example, we've got 15 left over. that would mean that in the 1920 financial year, you could make a $40,000 deductible contribution to super, which is, it's a really, really good piece of legislation that hasn't been talked about a lot. It's sort of slipped in under the radar in the budget, but it's something that people should be aware of and start planning on how they can take advantage of it.
Yeah, so it doesn't end at the end of this financial year, it actually starts next financial year.
Well, that's right. It came into existence from 1 July this year,
Yeah.
but it's not of any use to people until we finish this financial year and we know what we've got to carry forwards.
And it lasts 5 years.
Well, it's an ongoing thing, but it's a rolling 5-year period. So
Yeah.
you need to just make sure that you understand when I can make the contributions, what the rules are to make the contributions, and how we play within the goalposts.
Why do they put a ceiling on the amount of money I can put in super?
Well, there's always been we've touched on this in other episodes, there's always been a ceiling on the amount of deductible contribution they can put in. I think really from a government standpoint, they just want us paying more income tax. That's really the only real reason, because if we jump back, 06, 07, I'm pretty sure you could put $100,000 in each and claim a tax deduction back then.
It's gone now though.
Yeah, it's gone now.
Yeah.
And then it came down to 50, then it went to 35, now it's at 25 for everybody. So this sort of legislation is really, I think, an indication that we've made things too hard to get money into super.
Yeah.
And the idea of super is obviously to fund yourself in retirement. And obviously the more you have, the less pressure there could be on the social system going forward. So it's a really, really good piece of legislation. And it's really powerful for people that have had some time out of work. So if you've been raising kids and you've come back into the workforce, really, really good for mums and dads that have been staying at home and haven't been adding to super because they've been a full-time parent. And no amount of money can reward you for the pain and suffering that causes.
Yeah.
It's also very good for contract workers.
Yeah.
So if your income fluctuates, so if you're self-employed and say you'd had a period of time of employment, a period of time out of the workforce, where you may or may not have been able to maximise your contributions, you'll be able to then take advantage of high income earning years in the future. It's also very, very good for people that have used their offset accounts very well, and we've touched on this in a number of other shows, where saving into your offset account and building up a cash bank while you pay off your house can then be very useful, because again, if you're self-employed, you've had a really good year, you've earned a lot more than you expected, you could use some of that money and potentially carry forward what you haven't used in future years and have $30,000, $40,000, $50,000 contributions in any one year.
Okay. Do you have to drop it in one lump?
No, you can put it in however you want during the year, so nothing changes in relation to the frequency or how.
But you've got to keep your eye on the fact that you can't do any more than 25,000.
Can't do any more than 25,000,
Right.
and you can't do any more than what you haven't used in the previous year. Okay, we come back to that example. 10 in, 15 spare.
Right.
We can do 40 next year.
Does that
and
mean
so
I've
on.
got to keep my eye on my super?
Well, you need to keep an eye on what's going in from your employer.
Yeah.
And as we keep saying, be informed,
Yeah.
be proactive, and understand where you can take advantage of this legislation. Another really, really good place that this is going to be beneficial is the sale of assets. Okay, so if you're expecting to sell, say, an investment property, and you know that in any 1 year down the track you may have a significant increase in your taxable income because of capital gains tax, then taking advantage of this legislation, if you'd had a $100,000 gain on the sale of an investment property, for example, and you'd carried forward and hadn't used some of your concessional limit, you could make a $50,000 or $60,000 contribution in the year you sold an investment property and help mitigate or manage your overall tax position in that way. So thinking ahead here and understanding when and how it can be used, really, really powerful piece of legislation.
It's strange that we can say thank you to the federal government.
Well, this is one of the few things that they've done over the last few years that have actually helped mums and dads out there, and I think the fact that they've helped mums returning to the workforce and dads returning to the workforce and really given them some benefits to put money into super, I think it's a really, really good piece of legislation.
It is a catch-up concessional contribution legislation. We'll clarify it as the next 15 minutes unfolds with Luke Smith, financial planner at Envision Financial. You can contact them on 62604749. But if you have a financial inquiry now, you can give them a call on 6255 1206 on Canberra Live at 4:45. to 5 with Luke Smith, financial planner at Envision Financial. They're at 4452 Townsend Street in Phillip, down the end of the roundabout upstairs, and you can call them on 62604749. Just want, because my head's a bit strange, catch up concessional contribution legislation, Luke. That's what we're talking about.
Correct.
In simple terms, what is it?
It's making the most of your deductible contributions to super each year and utilising what you don't use in this financial year and financial years going forwards.
Okay, closing the gap.
Exactly right.
Up to 25,000.
Exactly
Your
right.
employer gives you 10.
Yep, you've got 15 you haven't used. If you don't use it this financial year, you could potentially put $40,000 in, being 15 plus 25. You could put $40,000 in and claim a tax deduction in the next financial year.
You might have a windfall, you might sell an asset.
Exactly right.
That gives you 25
Yep.
grand.
You might have asset cash in your own name you've been saving. You might have money in an offset account. It's important to remember, obviously, 25,000, the most you can put in.
Right.
And there's a 5-year window that you can carry forward what you haven't used. And also the other caveat is your super balance must be under $500,000 at the end of the financial year prior.
Okay, so the financial year we're going through now, which ends on the 30th of June.
Yep. So as long as you're...
Super's got to be under 500.
Correct. Correct, that's exactly right.
That means next year, July 1, you can do this thing.
Correct, that's right. That's exactly right.
And they brought it in to give us a bit of a, I suppose, if you like, a semi-backflip on what they've taken from us.
Yeah, look, I think it's this is a piece of legislation that sort of screams, we've made it too hard to put money in.
Yeah.
We need to throw you a bone.
And given the fact that they want us to do this because it could ease the person on welfare
Oh, look,
in
exactly.
our later lives.
I think it's a wonderful piece of legislation that people should start thinking about. And I guess that's why we're bringing it up now, because we've got 6 months of planning to get ready for next year, so that you don't have to worry that in the past, if you hadn't put your money in, you'd lost that opportunity. Yeah. So now it's not a case of worrying about, well, I haven't put 25 in this year, but I can aim to do more next year, which is a good thing.
Okay, let's work it for ourselves. Let's mould this. We're going to fashion this for ourselves.
Yeah.
How can I make this legislation work personally?
Well, look, I think the best thing, the key takeouts for people to think about when using this legislation is looking at splitting balances between spouses. Okay, so if your husband or your wife has returned from looking after kids, and if we jump 2 or 3 years down the road and they haven't put $50,000 into super, she could, or he could, put potentially $75,000 into super 3 financial years from now. So understanding where your savings are coming from and using things like offset accounts and redraw facilities to maximise your tax deductions will be great. I think it's very important that people incorporate some broader strategies for this. So have a think about how you could use pensions to create some liquidity for yourself to then maximise your deductions. So if we're taking a pension out, as we've touched on this in other shows, an account-based pension or a transition retirement pension, they could be good funding mechanisms to then give you the free cash flow to put the money back into super and claim a deduction. So these strategies now start to sort of really get some momentum when we bring together pension strategies, offset accounts, redraw facilities, savings plans. We're finding ways to incorporate 2, 3, 4 strategies to maximise both your cash flow, your tax deductions, but then also the primary goal for most people is building their retirement wealth over time and making the most of pieces of legislation like this.
Okay. Do I have to put it in a lump sum, or can I?
No, you can make a
25
contribution.
grand, I know I've got $25,000 and I haven't got that money all in one lump.
Yep.
How often and how much can I put in over the course of 12 months?
Doesn't matter how you do it.
Doesn't matter.
No. So some people will salary sacrifice.
Yes.
And I always say now, if you question your own self-control, salary sacrifice is good because out of sight, out of mind.
You tell the pay office.
Exactly right.
Another $100.
Personal deductible contribution any time during the year, weekly, fortnightly. 1st of June, you could put a whole year's contribution in. That legislation is very powerful and gives you that flexibility. And we've worked that into other strategies in the past where we've said, build up your offset account and pay off your mortgage, and then look to draw that money back out to get a tax deduction, and you can get the best of both worlds, which we've touched on in other shows.
What happens if you have several superannuation accounts though?
It doesn't matter where you put the money. The threshold is applied across all funds.
So if I've got 5 funds, can I get 25,000 into each of them?
No. So it's 25,000 from all income sources and any sort of superannuation structure that you have. You can spread it around if you want, but you need to make sure you've kept track of what you've put where, so
Once
you don't
again,
breach
Luke
it.
Smith, you always say keep your eye on what your super's doing. Are you getting the right bang for your buck on the particular super? Are you paying too many fees? So get it all into one thing.
The other thing that this is really, really good for is if you'd had a redundancy Let's say you got made redundant and you'd had a significant service period with your employer, you're going to have wages for that year plus a redundancy payment, which will push your income tax bracket potentially a lot higher in that individual year. This could be a good way of using carried forward legislation. As you say, it's going to take a few years for this to really build up some bang for your buck, but it's important that people understand when they can use it.
Long service leave.
Well, that's exactly right. So that's taxed at its own threshold, but included in the bucket in the year that you get made redundant.
You get a bonus.
Correct.
You
That's
get
exactly
extra
right.
commission. You may be a salesperson.
Exactly.
That, and you can tip all that into this.
Exactly right. So understanding what you've used in the past going forwards will be really powerful for giving you the discretion to be able to maximise and manage your tax position during the year, which is really good. The other really, really good idea, or the really good way of using this is, it's a good way to help manage the transfer balance cap. So $1.6 million is the most amount of money that you can have. And this is a very good way of being able to catch up money into a spouse's name, for example. Very, very powerful for CSS, PSS, DFRDB and MSBS, the government funds. The defined benefit schemes are assessed against that transfer balance cap. And where people are going to be in excess, one potential strategy could be to get money out of the individual's name who has the pension and build up super in the spouse's name so that you can have as much in super as possible and not pay any income tax when a pension's commenced.
So you can use this extra concessional contribution legislation to work for those government supers as well.
Well, that's exactly right. They're entitled to this as well.
Right.
You need to check and make sure that your fund can receive the contribution. Some can, some can't. It depends on your fund. So always start with your fund. Can I take advantage of this? If you can't, just open a personal superannuation fund and just work that into your broader strategy. But making sure that you're not over that $1.6 million transfer balance cap threshold will ensure that you can have as much tax-free money in super as possible when you actually do retire.
I think we're going to hear a lot more about that as the government starts to edge toward a federal election.
Yeah, look, it's
because it sort of wasn't there around in the budget, was it?
No, well, I think it's definitely a time of unknown change.
Yes.
And I think it's time that the punter actually had a few wins and they actually rewarded people for saving, and they rewarded people for adding to super, and they rewarded people for thinking about retirement, and this is a really, really good piece of legislation.
Your acronym of the week is CC, obviously.
CC,
Concessional
contribution. So we have concessional is just a fancy way of saying deductible.
Yep.
So concessional contribution is any money that goes into super where a tax deduction is claimed. That could be salary sacrifice, that could be a personal deductible contribution. It's the $25,000 threshold, and it's important that people just wrap this up as part of their broader strategy, because it's going to be really, really powerful going forward.
You've got 6 months to contemplate it. Get financial advice from Envision, and you can call them on 6260-4749. 6260-4749. You can go online to Envision Financial. Luke Smith and his team at 4452 Townsend Street, Phillip, will see that you can get this plan up and running now. But start thinking about it now, because it kicks in on the 1 July.
Look, I think people need to take the January as a good time for a health check. Good time to just make sure that they're not missing out on other pieces of legislation they may not have known about, because if you can maximise your deductions before June, you can carry them forward into the next financial year, and you haven't missed out on things that you were entitled to. So
Envision Financial, 6260-4749 Townsend Street in Phillip. Luke Smith, we will talk in again next
See you next week.